Hey, everybody, and welcome to another edition of the Buddy Study Group on the individual side of the house. Thank you for joining us today, and we are joined with our special guest, Rhonda Bills, longtime study group presenter, longtime friend of Buddy INS, longtime long-term care expert, and she's going to be talking about long-term care partnership, Medicaid, and DRA, the Deficit Reduction Act 101. A very valuable conversation that I think we're not having enough as agents and long-term care specialists. Kind of a very high value program for many long-term care clients and prospects out there. And Rhonda is here to shine a bit of a light on that for us and help us brush up a bit if we already know a little bit about that game. So Rhonda, thank you very much for being here. It's been a while since we've gotten you in front of everybody, so really happy to have you back, and you can take it away whenever you're ready.
Very good. So first of all, I want to preface today's inspiration comes from Jim Bosley, shout out in South Dakota. Him and I were talking yesterday, and he was talking to me about explaining spousal impoverishment formulas. And I'm like, yes, yes, yes. And then I was talking to Jason, and I'm like, yeah, we should talk about partnership, keep it fresh. So that being said, Jim gets all the accolades for today's topic. Okay. So I receive phone calls probably once a month, once every 2 months from local financial planners. And the conversation goes something like this. Hey, Rhonda, it's so-and-so. I have a couple questions for you. I have a client and they do not have long-term care insurance, and the spouse, the husband, or whoever it is going in a facility, and the wife is wondering and worried, what can she have? Can you refresh my memory how this works? So quick raise of hands. How many of you have had that phone call? Anybody here else fortunate to get those phone calls? Great. Jean is, Jeffrey is. If you have not had the phone calls, if you are putting yourself out there advocating for long-term care in the community, with other professional networks, I'm going to guarantee you at some point in time, you probably will get this phone call. So today we're going to talk about brushing up on Medicaid 101. Why do we have partnership laws? Why are they relevant? Because I hear, some advisors don't see the relevance of partnership. Maybe maybe they're fortunate and they have nothing but $4 or $5 million clients, and partnership is really not that important to them. And I can understand that. But I would like to say that I'm going to guess all of us have some clients that maybe are in the $200,000 to $1 million range for assets. And so I do think partnership does play its place. It has a role there. So one of the reasons why we're out there advocating for families, my opinion, there's two reasons why we're advocating for long-term care. One, most of these people have families that they love, right? They don't want to have their adult children, their spouse, to have to be dependent upon taking care of them. We don't want those unwanted consequences on the front line should we need care. And then the other one comes down to, after they've exhausted the personal family resources, usually it trickles down to a financial consequence of how are we going to how are we going to be able to pay for this care, because we burned out our personnel, our family members on the front line of defense, which is giving the actual caregiving. And this is when families start to sweat. They start getting concerned, because I really doubt that you could pull up the cost of care survey and find a state, a location that a nursing home is not under $8,000 a month. Mostly I'm seeing 10, 12, 13. Every now and then you might get an 8 or 9,000, but for the most part, where else are you going to come up with an $8,000 check income to pay for an $8,000 a month bill? So we're talking about the financial consequences. So let's take a little bit of a journey, go back in time. I'm not Michael J. Fox. We're not going to do a time machine, but walk with me. 1986, fast forward, or actually not fast forward, backtrack, 1986, Robert Wood Johnson started the partnership program. And he said, he kind of saw the future, and he said, we've got a big concern. We got baby boomers aging. We had cost of care rising. how are we going to fund this as a nation for long-term care? Because they know it's so expensive. And he also knew that Medicaid at the time was paying a majority of the care for Americans. So he started the partnership program. And the partnership program, for those of you, I'm sure everybody's had to have taken their partnership certification, but it is a joint, and this is why it's relevant, both state and federally funded program. So you got both federal tax dollars and state tax dollars coming together to fund Medicaid. Now, all the time we get people that confuse Medicare, Medicaid, they intertwine them together. Just remember, our Medicare is our health care. I remind people, Medicaid ends in AID. To me, that means aid, and Medicaid is aid for the poor. So if you raised your children or maybe stepchildren, at one point in time, you were the governor of that state of your household, and you got to write the rules. If they want the car growing up, they want the extra allowance, you had some sort of guidelines that said, hey, you got to meet the guidelines before we, the governor, is going to write the check out of this household to give you money for your car, your allowance, or whatever. Well, our tax system doesn't work much differently. Medicaid is funded from tax dollars, both state and federal. And before our state tax dollars are willing to write that check for $8,000 a month, there are rules in place that you have to qualify because it is aid for the poor. So there's 3 means tests that you have to have, and you can't need one of 3. You have to have all 3. Similar to Medicare, if you want those skilled care benefits covered under Medicare, you have to have their 3 guidelines. You know, you have to have been hospitalized 3 nights, go from a hospital to a skilled rehab facility, and the Medicare facility needs to be a licensed facility. So if you want Medicare to pick up the skilled care, because we all know Medicare pays skilled care, Medicare does not cover assisted living. Medicare does cover home care, but it's very limited. Now today we're talking on Medicaid. So they too are going to write the rules. So number 1, you must prove that you have poor health because Medicaid is aid for the poor. So what is poor health? Any ideas? We talk about them every day, talking about long-term care. Suzanne's smiling. I'm going to pick on you, Suzanne. Do you have any idea what the state's definition of poor health might mean?
I would say that you need to have some support for the activities of daily living.
You got it. 2 of our 6 ADLs, that's what we talk about, or cognitive impairment, right? Okay, so number 1, we got to prove we have a poor health. Number 2, we have a poor income means test. Now, this is relevant because a lot of us will talk to people that will say, well, my grandmother went on Medicaid and she didn't have to worry about a poor income means test. All of us will have experience from past generations that Medicare was wonderful, paid this, but maybe today it's not. We know Medicare is constantly making changes. Medicaid also updates their rules, regulations, and requirements. So prior to 2005, we only had 2 means tests. We had the poor health means test and the poor asset means test. The poor asset means test says you must use your own resources, spend all those down to $2,000 before Medicaid Title 19 will give you an application to apply for Title 19. In 2005, fast forward, President Bush came in and said, why don't we have all states offering partnership? And I'm going to circle back around. I'm kind of walking over the map here, come back around to partnership. But in 2005, President Bush says, why don't we have all states offering partnership programs? He also made some specific changes on the look back period because very common, grandma owned the farm, $1 million farm, grandma had a stroke. The next day, grandma transferred the farm to her son. And the 3rd day she applied for Medicaid because, hey, I don't have the asset. And you and I got to pay for grandma's extended care in the nursing home, and the son inherited the $1 million farm. And our government said, you know, that's not really fair. People are cheating the system. So we decided we better have a 5-year look back period instead of a 3-year look back period. We also decided instead of counting 3 years to 5 years from the date of transfer, we're now going to go from 5 years from the date of application. So they're going to catch more people earlier on to see if that transfer was being made. And another thing that they did was they said, we find there's a lot of people taking their $750,000 401k and they're annuitizing $500,000 so that their spouse always gets a really nice hefty monthly income or annual income for the rest of their life. And you and I now get to pay for their care. So we found there's a lot of people always constantly cheating the system. So one of the parts of the DRA, Deficit Reduction Act, was we're going to change the look back period. We're going to now say we have an income means test. So it's no longer just health and wealth, it's health, wealth, and income. So if you have more than, let me see, I look at my notes for my numbers, and if anybody here knows it, wants to blurt it out, you will not offend me, about $2,465 monthly income, you are not as poor as you think you are. So what happens all the time is people may apply for Medicaid and they says, yep, I've got a Social Security, I've got maybe a small pension, whatever it is. If it topples over that $2,465 monthly income, you are not eligible for Medicaid because you are not poor. Now it forces people to go down to the asset means test. And the asset means test says, you must pay 100% out of your pocket, because in our country, nobody likes paying more for tax dollars. So we simply do not have enough tax dollars to pay for everybody in our country. That's not getting better. So they say you use up your money first, then Medicaid will become a secondary, a supplement, a safety net, I call it, a backup plan, once you've exhausted all your resources. So let's talk about that phone call from the financial planner. Let's assume that we have a household. We got a husband and wife. One spouse needs care. The other spouse cannot physically take care of them for whatever reason, and they have to go to a facility. Okay. Obviously, Medicaid says, hey, you spend your assets down to $2,000. So the spouse is worried, what about me? What about me? What am I going to have? So we have what we call spousal impoverishment laws to protect the community spouse, or I call them the healthy spouse, the one that's living at home in the community. So what can the healthy or the community spouse have? Anybody know? Want to chime in here? It's a group session here. What'd you say, Robert?
200,000.
$2,000. Yep. So the healthy spouse can have one home to live in. So if they have a second home, a cabin, weekend home, beach home, the unhealthy spouse now goes to the nursing home. That's their new residence. So the healthy spouse, the community spouse, can have one home to live in. There is a maximum. It's usually around $785,000, $800,000, depending on what part of the country. But for the most part, you can have your home. They're not going to make you sell it unless you're over that maximum on the value of your home. The healthy spouse may also have one automobile. And this is what Jim Bosley taught me for years. So now one spouse needs care. We're going to take Mr.'s truck, his Jeep, whatever he has. We're going to take Mrs. Smith's Honda. We're going to sell them both. And she's going to buy herself a Mercedes, because this will probably be the last vehicle she's going to ever have. So the state does not limit or put a cap on the value of her automobile, but she only is going to retain one automobile. Okay, so follow with me so far. I'm going to make an assumption. Mr. Smith's in the facility. Mrs. Smith gets a home to live in, one car to drive. Now it gets fun. She can have half of the combined marital assets. It does not matter if he had a 401k in his name and she had a 401k in her name. Maybe he inherited some assets, a non-qualified annuity from his parents, and she had a Roth IRA in her name. When you are married, You married for better, for worse, for richer, for poor. And Medicaid sticks to that. We do not care if you have a prenup, if it's your second marriage. If you're married, your social security numbers are linked together. And what's yours is mine, and mine is yours in the state for Medicaid's mind. So Medicaid are going to take a look at your combined marital assets. So again, maybe they have something joint, maybe his, maybe hers, maybe there's some other things joint. It doesn't matter. You put it all in that combined marital assets. She can have half up to the state allowable maximum. We call it a ceiling, which this year in 2024 is $154,140. $154,140. So let's take an example. Let's say your client has $500,000 in assets, checking, savings, money market, CDs, 401ks, non-qualified accounts, you name it. She gets the home, the automobile, and there's $500,000 in assets left. Logically, you would say, well, Rhonda said I can have half of 500,000 is 250,000. That's correct math. However, the state is going to say you can have half up to the maximum threshold, and that's the $154,140. So she gets the home, the automobile, then we got the $500,000 home. She's going to get 154 of the 500,000. So the remaining, what is it? Roughly 346,000 before Title 19 will give Mr. Smith an application to apply. He's got to spend his 346 down to $2,000. Everybody with me? Now, let's say you have a really unfortunate client, and I hope you don't, but let's say they have 50,000. Maybe they're renting an apartment, a condo, or well, they wouldn't rent a condo, but maybe they're renting and they just simply don't have the assets. So let's say they have 50 in assets. She can have a place to live, a car to drive. Half of 50,000 is how much? 25,000. However, the state is going to take pity on them and say, we got to minimally give them a floor. Okay, so the floor is 30,828. So even though half of 50,000 is 25, Medicaid's going to say we got to live the community spouse minimally. We're going to give her 30,828. Okay, the rest of it will be considered Mr. Smith's portion of marital assets. And once again, before an application goes out, he's going to have to spend his roughly 20,000 down to $2,000 before he gets an application to apply.
Hey, Rhonda, we had a good question, if you don't
Right.
mind me asking. Do all states have that same asset threshold? I know you're located in Iowa. Is it different across other states? And is there a place where people can look up their thresholds in their state?
So first of all, yeah, you can go online and look up your state Medicaid requirement. I know Phyllis Shelton, I don't know if she's on today or not, but she's got a chart on her got LTCI. It's got a chart for all the states. I would tell you, for the most part, all the states are going to be the same, with the exception of your extreme east and west coast, maybe California and New York. But for generally speaking, that 154,000 and the 2,000 spend down level and the 30,000 floor is going to be pretty much unison.
Yeah, and I'll put that in the chat for everybody because that was a good reminder. That is a great article by Phyllis, what your state lets you keep. So you could take a look, see what applies to your state.
Okay, so now let's take another scenario. Let's say, okay, so first of all, are you starting to feel the stress that Mrs. Smith is now feeling? When you're married, you have two incomes coming into the household to pay the bills, right? Pretty simple. Now, Mr. Smith goes to the nursing home. Guess what? His income follows him to the nursing home. So now Mrs. Smith has only her income And he's raiding the portfolio, taking $10,000 a month every month. And she's watching it and she knows she's only getting 154 and she is scared to death. This is why we do what we do. People do not understand this. This is what you're charged. I'm charging all of you to go out and make sure we educate these people because they don't want a rude awakening. Okay. So let's talk about income. Very common. Not so much, I'm still seeing it today, but for a long time, men were the primary breadwinners. Doesn't have to be a male female thing today, but still very common. One spouse may have higher income than the other spouse. So if you have the healthy spouse, first of all, it's good to know the states will never make the community spouse, the healthy spouse, use their income to pay the unhealthy spouse's bill. So they are able to retain 100% of their income. Okay. Now the question is, hey, we had both incomes coming in, his income's gone, but I got to pay all the bills and I've got reduced income and he's draining the portfolio account. If her income is below what they call the monthly minimum what is it called? Maximum monthly minimum needs allowance. Okay. So if the healthy spouse has less than 2,465 monthly income, and sometimes I run into people, they just have Social Security. Maybe they've got 1,600 a month. Maybe the spouse, the unhealthy spouse, has Social Security and maybe they have a pension. So maybe they've got 4,000 a month income. If the healthy spouse, community spouse, has less than 2,465, the state will allow her to have some of his income to bring her up to that minimum floor, that minimum threshold of 2,465. So an example, if Mr. Smith has 3,000 monthly income and Mrs. Smith has 1,600 monthly income, they would let Mrs. Smith keep her 1,600, but they're also going to let her have 865 of Mr. Smith's 3,000 so that she can have enough income because she's the only person in the house. She's got to pay all the property taxes, the insurance, the utilities, groceries. She's got her Medicare premiums, you name it. So they're not going to impoverish her totally because next thing you know, she'd be applying for Medicaid. And then we got 2 people on the Medicaid payroll and taxpayers want less people on the payroll, right? So we have these spousal impoverishment laws for a reason. However, it's not a walk on the beach. It's still going to be reducing their income stream. So whatever's left, Mr. Smith's going to pay for his care. There are some little nuances like he can retain his Medicare premiums and he can have his monthly needs allowance, which I believe this year is $60 a month, but the rest of it will go for his care. And obviously he's going to be short, so he's going to be dipping in the portfolio to spend down to qualify for Medicaid. Okay. I'm going to stop, pause. Everybody with me so far? Now we have this really cool law. It's called the partnership program. And this is where I see the value. The value comes in if you have a qualified partnership program and it pays, let's do simple math. Let's say you have a 5,000 monthly benefit. You've got a 3% compound inflation. Fast forward 23 years from now, your policy inflated to $10,000 a month and they bought a 3-year policy. So $10,000 a month times 36 months, long-term care paid out how much in benefits, total lifetime benefits? Somebody?
360.
Thank you. 360,000 tax-free to go for their care. But after 3 years, they still need care. But the policy paid everything it promised. Now you put a protective wall around 360,000 of that $500,000 marital asset pool. Okay, so now Mrs. Smith's still going to get her 154. Remember, he had to spend his 346 down to 2 to qualify for Medicaid. Well, because he had 300,000 first out of the gate from long-term care, he's going to have a protection of 320 $2,000. So after 3 years, he still needs care. He doesn't spend 346 down to 2. He spends 346 down to 302. Okay. Everybody get that? Now, after the 302, Medicaid will give him an application. Then it gets to the fun stuff about if you're in a cap state that says, hey, we are going to say if your income is over 2,828 monthly income, you still have too much income, you're not going to qualify for Medicaid. Well, all my assets are gone. I can't just plant a tree and say, grow me some money every month to pay the bills. So how am I going to qualify for Medicaid? So we have 23 states that are called cap states, and it's a Mickey Mouse way. What they do is you set up a builder's trust. So all of your income goes into that trust. And then it's a way to say that they can apply for Medicaid. So the income goes into the trust drains the income every month, pays the nursing home bill, and Medicaid will come in and pay the difference. Okay. Let's see, what else do I want to tell you? Incomes. Oh, you remember at the beginning, I told you Medicaid is both a joint federal and state program. Did you know, or how many of you knew? Make sure you're all with me here. How many of you knew that Medicaid is treated like a loan? You ever loan money to your kids or somebody and say, make sure you pay it back? Medicaid, when you're signing for forms, it's treated like a loan. That's why we have what they call Medicaid recovery laws. So everybody thinks going on Medicaid is free. It's not free. So if you spent your assets down to $2,000 and you qualified for Medicaid, and Medicaid came in and paid $100,000 before your passing, you have a $100,000 tab with the state of recovery. And the federal government requires, if the states want any of our federal tax dollars to help their states' Medicaid budgets, and I will tell you, Medicaid is typically the biggest budget of every state next to education, they have to have a recovery law in place. So that means at the time of their passing, they're going to do a sweep through and make sure there's no any other assets they've uncovered. Typically, they will not recover anything because they're really thorough before they let you apply. But what happens when that second spouse passes away, because remember, Rhonda said she could have the home, the automobile, and the $154,000. When the second spouse passes away, Medicaid's going to do another thorough sweep, and they're going to see if there's any assets left over, and they will send a letter to the estate and say, remember when we paid $100,000 for dad's care, we let you keep your job and your lives? Well, the bill's due. We're calling the notice. We want our money back. And whether they put a lien on the house, whether it's a life insurance, whatever it may be, they'll be first in line to get the bill. Okay. That's important to understand for two reasons. People think Medicaid's free. It's easy. It's not. There's a bill attached to it and you got to pay it at some point. You pay it up front, and then you could technically, maybe in the end, be responsible for paying in the end. The other thing you want to know about the partnership program laws, not only do you retain the asset up front, because remember I said, gee, long-term care paid $300,000, so we're going to let you keep $300,000. It is also exempt from recovery laws. So now Mr. Smith spent his 346 down to 302. Mrs. Smith gets her 154, the home, the automobile, and the 300,000 to live off of. She can't do anything about his income's gone, but at least she's got some more assets to live off of. When she passes away, the state will not come back and ask for their $300,000 back. So not only do you protect the asset up front, but it's also exempt from the recovery laws on the back end. Now, again, if you're dealing with high-end clients, $4 or $5 million clients, maybe that asset protection means very little. But I would like to say, I'm going to guess a lot of us have some clients in the 200 to $1 million range, where taking $400,000 out of your care can make a big impact on that household or family. So I do feel partnership has its place. It may not be a perfect fit for everybody, but it does have its relevance, in my opinion. Okay, I see a lot of messages coming in. I'm letting Jason kind of.
Yeah, you want me to take you through a few questions?
Yeah, go for it.
First, Lynn, you had a good question you sent me directly. Would you just mind unmuting and asking Rhonda directly?
Sure. Hey, Rhonda.
Hello.
I work in one of those Northeast states where the cost of care is not $10,000 a month for nursing home. You know, we're talking 13, 14 grand a month. So my question with regard to partnership is, you know, for example, Mutual of Omaha, maximum monthly benefit they issue is $10,000 now. That doesn't even cover 1 month, a full month in a nursing home in the state of New York or in New Jersey. So if I've got to spend down, if I've got a policy that's paying me $10,000 monthly benefit, and my nursing home costs are 14 grand, I've got to spend $4,000 a month. Till when? Because I've got to, my understanding is, maybe I understand it wrong, is I've got to spend it down until my LTC benefits are completely used up. And that's when I can keep my money, etc. So to me, the partnership may be next to useless in this situation, because if I've got somebody that's only worth $500,000, or let's say they're worth $1 million, but $700,000 of that is their house. All right, say they got $500,000 in assets. I mean, it's gonna 4 years of the benefit of, you know, payments going out at $4,000 a month plus whatever it grows at, etc. Like, there's not going to be much protection left.
Well, you're right. It's going to depend on how much their asset base is and how much insurance is paying. So number one, I think of it this way, Lynn. Every month that the insurance sends a check for $10,000, if you got your asset pool, the 500,000, I think of it starting at the bottom, that's 10,000 right there protected. Boom. Next month, 10,000 goes out, 10,000 protected. You're right. Off of the top, you're taking 4,000 every month to co-share. Insurance is paying 10, you're co-sharing 4 out of.
But I can't even, but what if the part of the assets, I mean, all this stuff, you know, all the stuff you're allowed to keep, they're gonna already be going into them before the benefit, depending upon the metrics of the amount. They could easily already have gotten way below what they're allowed to keep because of having to spend that extra money in a state, in states where you can't even buy enough benefit to cover the full monthly benefit.
I mean, that could be a situation. It just doesn't really happen. I've not ran into
Okay.
it. It could be. The other thing that you could do is, you know, it's going to cost more and it's going to depend on their age, of course. But, you know, you could look at the higher inflation to build them more money sooner, right?
Well, I'm actually thinking I'm thinking the opposite, maybe only use a 3% COLA because you have to use a COLA, and buy a 2-year benefit period with the maximum amount of insurance that you can get if you're going to pay the same, if you were going to get a 4-year for a lesser amount, because if you end up only needing in-home care or, you know, somebody coming into your house anyway, you know, you're not going to use your full benefit up if you've got a $10,000 monthly benefit for 2 years versus getting a $6,500 monthly benefit for 4 years. That's where my thinking's going now.
Totally, I would agree with that. Get as much out of the insurance up front, get you a deeper pool at a shorter width, get you as much insurance, because all those dollars paid out is a dollar of assets that is protected. So if you do exhaust the insurance sooner, you know you've got that asset base protected.
Right. Thank you.
Totally agree with that.
Okay, thank you.
And I would add one thing. Sorry, I jumped on a little late here, but
Too.
what is the alternative is always the question in my mind, right? Is there something better that you could do instead? Usually this is, you know, combining different resources always gives people more options. And there's no downside unless you're selecting an inferior insurance option because you want partnership. So if they're going to do this anyway, and they're going to use insurance, then they're going to get value out of it, no matter what, even if it's partial coverage. Or having a family caregiver spend less time and being able to use it in the home and not having to just go to a facility. Because we can't predict, where we're going to use the care necessarily in the future.
I have a question regarding that, Rhonda. So I am a reverse mortgage planner with Fairway. And when you do a reverse mortgage on a primary home, not one, but two security deeds are recorded. The first one is recorded in favor of the lender. The second one procedurally is recorded in favor of HUD. And so some of my clients have, because they want to stay at home, they don't want to go to a facility, and they want to be able to have folks come into their home. And they understand that Medicaid is a loan, but when Medicaid goes to recover that, there's two liens. They're actually in first lien position because the borrower has used their equity up, right? I wanted you to comment on that.
Well, I'm gonna be honest, I'm not that versed on the reverse mortgages. So I don't, if Mark or anybody else has an opportunity to chime on this one. Honestly, Jeannie, you probably know more about that process than I do.
Oh, well, I'll mention that when it comes to estate recovery, they rarely get enforced. So even though they have the right to do that, it's only in egregious circumstances when the kids have taken advantage of the public funds that they go after them. So that's theoretically possible, but not practically. We haven't seen that being enforced that much. And when it comes to the reverse mortgage, though, you kind of go back, Jeannie, to the stuff well, which is that's a non-recourse loan. And I think the protections there, I'm not aware of how they interact or if they interact at all with Medicaid as a lender. So I think you would just follow your reverse mortgage protections first,
Sure.
and then secondarily, whatever the Medicaid you need to pull from Medicaid.
Got it.
And
Got
it
it.
makes sense what Mark is saying, because remember the whole purpose of having these partnership program is because Robert Wood Johnson said, we see the need for people aging, cost of care rising, and low Medicaid budgets. So they may not be so assertive in recovery on those reverse mortgages because they took their own asset, they reversed it, took the equity out, as opposed to saying, hey, I could go to the nursing home, let my wife keep the house, and then we could have taxpayers pay for my care. So it would make sense what Mark is saying there, in my opinion.
Yeah, so just moving through a few more chat questions here. Had one early on. Any thoughts or anything that you may have readily available? And just so everybody knows, Rhonda is based in Iowa, but does work in a number of states, but a lot of the numbers used and accompanied with Phyllis's chart of all 50 states is kind of based on Iowa. But any thoughts on what % of policyholders exhaust the carrier responsibility and then fall under state backup? Anybody on the call, just in general, have data on that?
Very few.
Mhm. I can't remember. I know with CLTC, we do have a number on that. I think it's single digit numbers of actual people that exhaust their long-term care partnership, long-term care policies and go into that. But that in a lot of people look at that as a negative. I think of it as a positive. Right? It's the worst case scenario, because when they first started offering long-term care, they had unlimited, everybody was selling unlimited because they wanted to make sure they never run out of money. Well, this is an alternative if you can't afford an unlimited, and a lot of companies don't offer it. If I do a basic 3-year policy and you got insurance coming in, but worst case scenario, if you do exhaust it, you got a little bit of asset protection because you at least bought the first 2 or 3 years of care instead of exhausting their insurance. So in my mind, I think it's still working.
Yeah, it's not a meaningful statistic either, because most of the partnership states came out 20 years ago or less. Most people haven't actually gone and claimed yet who bought those policies. And then therefore they haven't exhausted their benefits yet. So you can't judge it yet based on what the current ratio is. You have to look at what looking out 10, 20, 30 years. It's going to increase that percentage as we go.
Yeah, and to Mark's point, the DRA was passed in 2005. I'm in Iowa. Our state did not pass our partnership law till 2009. I think Minnesota was 2007. So, you know, we all know it takes a long time for Congress, legislators, senators to pass laws and get their act together, figure it out, because they got so many people involved trying to figure it out. So even though it was passed to say, why don't all states offer it? We still have 4 states don't even partnership yet.
Yeah, and kind of in the same vein as that thought, Diane asked, are recovery rules still applicable in the initial 4 partnership states? So we're talking New York, Indiana, California, Connecticut.
I want to say yes, but I think California's law might have just changed. Like they had a lot of change on.
Yeah, well, they actually removed the asset limit for Medicaid as far as what can be retained, and that can actually be seen in the link I shared from Phyllis's site that's updated for January 1, 2024. So that's an interesting development for sure. If anybody has comments on that, they can feel free to speak out.
Yeah, they still have the income limit though, just not the asset.
Yes.
I'd have to look it up. I do believe I do have a resource that would tell me how many states are recovery. But I would tell you, my gut instinct says all the states have the recovery, because if all states are getting the federal dollars, the federal government says all states must have a recovery law. So my gut instinct says all of them have recovery in place, even the 4 original.
Okay. Cindy, if you are still on and would like to ask your question out to Rhonda, definitely feel free.
Yes, you kept saying the spouse is protected. What if there's like an estate, a dependent child, something like that situation?
All right, so that's where it gets really nitpicky, and I'm not an attorney, Cindy, but there is some allotment that you can go to a estate planning attorney and set up a special needs trust to divert some monies going into a trust to help a special needs child, that sort of thing. But that all has to be done ahead of time and done legally.
Yeah, Kent, if you'd like to ask your question aloud as well, that would be great. If you're with us.
If there's no partnership plan in place, once the healthy spouse passes away, can Medicaid require that any adult kids pay back the amount paid by Medicaid, assuming that, I don't know if the look back applies at all, 5-year, because I've heard of stuff like filial laws, and forgive me if this was talked about.
Yep. So also the federal government has allowed all states to have filial laws, FILIAL. And what that says is it allows the government, the state Medicaid, to go to the adult children to pay the loan that's due. I believe it's like 13 states that actually enforce their filial laws. And if you Google, filial laws, states filial laws, it'll come up and tell you. A lot of states, even though the federal government has given them the permission to do it, a lot of the states, obviously we have more than 13 states, do not, proactively enforce those laws. I have received those phone calls in states where the adult children are panicking because they want the money, and they say, we'll take the money back now, and if not, we'll set you up on a monthly payment plan.
Wow, thank you. I actually had a second question related to like annuity income. Let's say somebody has annuitized an annuity, they're receiving the income, it fully covers their current need for care, perhaps in assisted living, and then let's say their care needs go up and now they need skilled care, which is a lot more expensive. Now they find that the income they have, which includes their annuity income, is not fully covering it, and they don't have enough money. Would they, in order to qualify for Medicaid, would they need to put that income into a Miller Trust in order to qualify?
Yeah, so just to clarify, because there are a lot of moving pieces there. Number one, is the unhealthy spouse have the annuity that's been afforded to pay for their care with Social Security? Or are you talking about the annuities for the healthy spouse?
The annuity is actually for the unhealthy spouse.
Okay, so first of all, there's no Medicaid application because they're able to self-fund their own care, correct?
For the current situation, yes.
Okay, now their care has increased.
Right,
Now they have more expense than they have income.
correct.
We're gonna go to the asset means test, right?
Hmm.
They're gonna look at the asset. They can take a chunk of the asset to purchase an annuity to bring them up to that minimum floor level. But in your example, my guess is they're already surpassed the ceiling, the max that they can have for income. If they've been comfortably paying 5,000-6,000 a month for their care, and now they got a bill for 8 or 9, they're probably not going to be able to get an annuity to create the additional income. So basically, the asset is going to have to go to spend for their care. Then yes, that's when they, if they're in a capped state, that's when they would get a Miller's Trust, apply for Miller's Trust. They'll put the Social Security, their annuity income, pension, whatever they have in it, and then they can apply for Medicaid.
Great, thank you very much.
If, by the way, if you have a spouse that's healthy and their income is low, they would, the states, they would allow them to take a chunk of the assets to buy an annuity, but only to bring them up to that minimum monthly needs allowance.
Okay, makes sense. Thank you.
Yeah, I got a question from Max in the chat as well. Sorry if this was already addressed, but what are the eligibility guidelines around in-home care via Medicaid? Any special means testing or clawback rules to be aware of there?
So basically, Medicaid home care was created as a way to help save Medicaid dollars. So it's a lot cheaper to keep somebody at home and cover Medicaid, but there's also regulation requirements on that. They're still going to have the income and asset means test, but they also have to have somebody at home 24/7. They can't be needing to go to a facility and only have Medicaid come out a couple hours a day. So the reality is a really small fraction of the pie is covered for Medicaid at home. It's called their home and community-based waiver program. But it's a really small fraction of what Medicaid pays. But yes, they're still going to have the same income and asset means test as if they were in a facility, but it's just in lieu of being in a facility, we can stay at home because maybe they do have a spouse at home or an adult child that's caring for them.
Good question and good answer. So just to bring it back to partnership itself, just as a review, or if you're brand new to this concept, partnership is only going to apply to traditional long-term care, and there are rules on what policy parameters qualify a long-term care policy for partnerships state by state. So you need to be sensitive about the state that you're working in. You need to be, aware of the parameters state by state. And, there are cases in which the parameters to qualify for partnership may push policy premiums above what folks are able to afford. So it's not something that can be shoehorned, but can absolutely serve the correct market, as Rhonda was talking about. Mainly, primarily serves those in the middle market. 200,000 to $1 million of assets, I think, is a pretty good marker that you set at the beginning of the call.
One other thing I'd like to end on here is keep in mind the timeline of what's going on. We start out with nursing homes and county homes, which were for the poor. They started shutting down the county homes, incorporating them in the facilities. People started selling, Genworth, CNA started, Unum started offering nursing home insurance because people were worried about paying $10, $20, $30 a day back then. So then things have progressed. Now they're tax qualified 2002, saying, hey, if you purchase long-term care, those benefits are guaranteed to be paid out tax-free. Then fast forward, you get 2005, where now we're doing an overhaul on who can qualify for Medicaid. We're making it tougher, expanding the look-back period. We're offering the partnerships. We're giving more carrots to dangle. We started offering the tax deductibility through the tax qualified policies for business owners. And then some states started offering their own state tax credit or deduction if their residents would purchase it, even though they're not a business owner. And then guess what happened? We had the Pension Protection Act come in, what is that, like 2008 timeframe? Correct me if I'm wrong, anybody here? That says, why can't we use non-qualified annuities, roll it over? Why can't we use cash value, roll it over into a hybrid life long-term care, annuity long-term care? do something, for the love of God, Medicaid screaming, just do something, take responsibility, quit relying on us taxpayers. So that's the timeline that I'm hoping that you're going to see, and why we're all charged to go out and keep talking to families.
Yeah, and you know, you started it with a call from a financial planner. They certainly are not interested in watching their clients impoverish themselves after building up such a solid financial plan for them for years and years and years. So this is yet another thing that make long-term care specialists a very good partner for financial planners. So keep that in mind. If you're somebody who's thinking, man, I really need to find myself more opportunities, Rhonda has given you an excellent case study that you can use to approach or get introduced to financial advisors to really be that expert on their side. Anything else? Oh, 2010 for the Pension Protection Act. Thank you, Jeff. Rhonda, anything else you want to go over with the audience, or anybody else? Any questions that you have for Rhonda?
I would say one more thing. I'm sorry.
Yeah.
Now, Buddy has done the continuation of what I just said. You know, we've started out with partnership, tax qualified, DRA, PPA, all this stuff. So some people, partnership is a big deal for them. Some people will say, why not take some of my 401k and roll it over to do a qualified long-term care? Why don't I take a non-qualified annuity that I inherited in Rubit or cash value life insurance? So that's why I say it's not a perfect fit for everybody. But what Buddy's been doing is educating you. We have all these different solutions. One is not perfect. It's, you need to know what solutions are out there in your back pocket to help match up for your clients.
Awesome. Thank you, Rhonda. And in the nicest way I can possibly say it, that was extremely dense in a very good way. You dove as deep as I think many of us wanted to. And I think this is a session, whether you're on this call or whether you're watching this recording now, I would go and watch it back. I'm certainly going to go and watch it back, because there were things I didn't even know I didn't know that you went over. And I have 2.5 pages of notes here. So thank you very much for volunteering this subject, because like I said, I think it slides under the radar for many folks, even among us who have been in the industry for 10+ years. I think it's something that still doesn't get enough light shown on it and can really make a difference for a ton of clients out there. So thank you very much. Thanks for always being a rock star and always being willing to get in front of the audience here to share what you know. The recording will be posted generally within about 20 to 30 minutes or so of the call ending. I'm pretty good at just uploading it straight after we're done. So thank you again, Rhonda. We really appreciate you, as everybody in the chat has said as well. Mark, do you have any items you want to share with the folks before we wrap it up and call it a day?
No, I think these kind of topics are really of interest, so we'll keep try to come up with new ideas like this. Thanks so much, Rhonda.
And a special thanks to Jim, because he was the study group presenter on this topic before Rhonda, and I know he and Rhonda are very close, and they are really carving out a wonderful knowledge source for these study groups on these kinds of topics. So if you like that topic and you want to see others that are like it, just let me know. And if you have any topics you would like to see, I am interested in making your wishes come true, and to get the person who is most credible to be able to deliver that wish. So thank you very much for watching. If you're watching the recording, we appreciate you being here as well. I'll see you on the rewatch, because this was a really, really good one that goes really deep. Thank you very much. Be well, and we will talk to you next week. Have a good one, everybody.